You think the Fed is done?
Do you feel like the bulls have that momentum?
The math doesn't work for this market to move too much higher.
The earnings recession has ended.
Q2 marked the low in earnings.
Yes, earnings weren't great, but they were better than feared.
Earnings came out better than we expected.
I do think there's a lot of evidence of the soft landing and that inflation's on a glide path much lower. And given how hesitant people have been and how much cash is on the sidelines, I think that resolves positively. I mean, the earnings recession has ended, so we're in a profit recovery cycle as well. A recession is a sudden change in business conditions because of leverage or commodity shock. We've had those shocks already. We had 2 quarters of negative GDP last year. Businesses aren't over-levered and households are not over-levered. In fact, next year, if the Fed pauses, mortgage rates could drop, which is a huge easing of household financial conditions. When it comes to valuations, X the FANGs, the market's really at 16 times, which is not demanding. And typically early in a cycle, you get huge multiple expansion. We haven't had that yet. So I would say it's undecided, but I think a soft landing, stocks have 20% upside, still sort of valid view.
You think the Fed is done, Tom? I mean, is this it?
Yes, that's one of the things we're watching for this month. I think when we get August CPI, I think the Fed probabilities for both a September and November hike drop to 0. And it's 7% and 35%. So there's still a huge way to go. And I think that's going to change positioning in fixed income, and it's going to boost equities as well.
What about the idea that historically the first rate cut isn't necessarily a bullish sign? I mean, I know there's exceptions to that.
Yes. But, as we all know, this hasn't even been typical cycle because normally stocks rise into the first few hikes and they fell 27%.
Yeah, even before the first one.
Yeah,
exactly. Is a bullish case contingent on relief on the Fed funds rate within sight?
I think it's going to be important, Michael, because next year, let's say inflation, the run rate is down to 3, and the Fed funds is 5.5. That's a massive, real tightening of financial conditions. That could tip us easily into a recession. So I think if the Fed is trying to avoid huge job losses and not so worried about what equity prices are doing, I think they'd be cutting next year.
One of the strongest points that the bulls had during the midst of this quarter was that, yes, earnings weren't great, but they were better than feared, and more importantly, they were troughing. That's really what you have to believe if you want to believe that this can continue into the second half of the year. I think it can. I'm most concerned now, though, about the consumer. There have been a lot of retail blowups. These types of things typically don't happen as one-offs. Usually when you start to see this, it gets worse and it's more than one quarter. So it's very widespread. It's very concerning. And if you ask me, what is the big risk now for stock market investors? I am not going to tell you it's market-wide or S&P earnings. I'm going to tell you it's consumer behavior changing from where it was in the first 6 months of this year.
In the short term, the market moves on behavior, and in the long term, it moves on math. And the math right now doesn't work for the bulls to continue their momentum, because to get to where we were at the high 2 years ago, right, to get back to 4,800, we basically need $240 earnings and an 18 to 20 times multiple. And that's really hard to justify, because what we're seeing is the economy is slowing. There are signs of consumer weakness. If rates stay higher, and the Fed's not talking about cutting, if rates stay higher, you cannot justify valuations. The really smart money, the really great rich investors, what do they value? They value the math of the equation behind investing, and the math doesn't work for this market to move too much higher.
The momentum is back in favor of the bulls. The market strength has been driven by the ongoing durability of the U.S. economy and, of course, the supremacy of U.S. tech. And so I still think those are the two big variables in the equation that the bulls have on their side. There's two headwinds coming at us. One is the resumption of student debt, and the other is kind of the ongoing drawdown of excess savings, particularly down the income strata. That said, let's think about this. Over the past couple of weeks, Walmart, Home Depot, Target, Visa, they've all basically told us the consumer's fine from a macro perspective.
How about yields, right? That's the big equation, right?
You get slightly cooler data, the bond market settles in, and the stock market moves higher. It's very reflexive in that regard. Again, my guess is rates will be here or higher for a while longer. I think the fundamental driver of higher rates has been good growth data, point to point. And again, I think that's on net positive for the equity market, even if on a given day or a given week, again, it introduces an element of turbulence.
But softening data over the period of the next month is a good good thing for stocks?
I don't think we're rooting for uniformly bad nor good news.
Are you a believer in the earnings story?
Our call as a house is 224 for this year, which is plus a percent, not that interesting, and then 237 for next year, plus 5%. We agree the sequence of basically the year is Q2 marked the low in earnings, and in the end, earnings came out better than we expected. So given, I'm sure we'll talk about this, given what a large share of the equation mega cap tech represents, given what we've seen from those top 7 companies, I think if I'm going to bet, I'm going to take the over on 224 and 237.